A government does not need to announce a tax increase to make you poorer. It can print more money, borrow more debt, freeze tax brackets, raise fees, impose tariffs, weaken the currency, or let inflation do the work quietly. Your tax rate stays the same. Your paycheck may even look bigger, but rent, groceries, fuel, and interest all take more, and life feels heavier. That is the quiet genius of hidden taxation. You still pay, but no politician has to stand at a podium and call it a tax. Welcome to the Finance Prep Academy, where money, power, and history collide, and nothing is ever as simple as it looks. Most people think taxes are what governments take after you earn money. Income tax, sales tax, payroll tax, property tax. The obvious stuff, the lines on the form, the deductions from your paycheck, the receipt at the store. But states have always had other ways to collect from the public. They can take directly through taxation or indirectly by changing the value of money, the cost of goods, the burden of debt, and the rules of the financial system. The first method is visible. The second is quieter. And in politics, quiet is valuable. Because visible taxes create visible anger. Raise income taxes and voters notice. Raise sales taxes and businesses complain. Raise property taxes and homeowners revolt. But inflation, fees, tariffs, frozen tax thresholds, debt interest, currency weakness, those are harder to pin on one decision. They arrive slowly, spread across millions of transactions, buried in prices, bills, rents, and interest payments. The state does not need to raise your tax rate if it can quietly reduce what your money buys. This trick is ancient. Long before central banks, paper money, and digital payments, rulers discovered that money itself could be manipulated. In the Roman Empire, coins were not just currency. They were political instruments. The denarius, Rome's famous silver coin, once contained a high level of silver. But as the empire grew more expensive to run, armies, borders, bureaucracy, grain supplies, civil wars, imperial ambition, emperors faced a familiar problem. They needed more money than the system could comfortably provide. Raising taxes was dangerous. Soldiers had to be paid. Citizens had to be fed. Rivals had to be crushed. Empire, as it turns out, has terrible monthly expenses. So rulers stretched the money. They reduced the silver content of coins, mixing in cheaper metals while keeping the same official face value. Under Nero in the 1st century, the denarius was debased moderately. Later emperors pushed the process further. By the 3rd century, during Rome's long political and military crisis, coins like the Antoninianus became severely debased. The state could create more coins from the same precious metal and pay soldiers, suppliers, and officials. In the short term, it worked. In the long term, people noticed. Prices rose. Trust weakened. More coins were needed to buy the same goods. The state had not passed a clean, transparent tax bill, but ordinary people paid anyway through inflation. Coin debasement was taxation with a mint stamp. Modern governments do not usually shave silver from coins anymore. They have more sophisticated tools now, which is always reassuring. But the principle remains. If the state can influence the value of money, it can influence who pays. Inflation is the modern version of this hidden extraction. Inflation is not always caused by government alone. It can come from oil shocks, wars, supply chain breakdowns, corporate pricing power, labor shortages, pandemics, and housing shortages. But governments and central banks can contribute through deficit spending, monetary expansion, ultra-low interest rates, and crisis stimulus. When prices rise faster than wages, households lose purchasing power. The government may not have raised your income tax, but your money buys less food, less fuel, less rent, and less peace of mind. If you own scarce assets like real estate or stocks, inflation may raise their nominal value. But if you mostly hold wages and cash, inflation is a slow leak in your life. Inflation also helps debtors, and governments are among the biggest debtors in the world. If a government owes fixed debts and inflation rises, those debts become easier to repay in real terms. Inflation can reduce the real value of debt without explicitly defaulting and without explicitly taxing anyone. It is not called a tax because no one votes for it, but it collects from everyone holding money. Then there is debt itself. Governments borrow to fund wars, crises, pensions, healthcare, infrastructure, and stimulus. But debt is never magic. It moves the bill through time. Spending happens now, payment comes later. That payment can arrive through higher taxes, lower services, inflation, austerity, higher interest costs, or slower growth. Britain, after the Napoleonic Wars, carried a massive public debt, but also built a powerful bond market that helped finance empire. World War I and World War II were funded through borrowing, taxation, and money creation on an enormous scale. After 2008, and again after COVID, public debt rose sharply across much of the developed world. Some of that spending prevented collapse, but once the emergency passed, the debt remained, sitting quietly on public balance sheets, like a guest who helped during the crisis and then moved permanently into the spare room. Debt is taxation with a time delay. It allows politicians to spend today while pushing the harder choices into the future. Maybe future taxpayers pay, maybe future services are cut, maybe future inflation reduces the burden. Maybe future governments refinance and hope growth solves the problem. But someone eventually absorbs the cost. The bill does not disappear because it was printed on a bond instead of a tax form. Another hidden method is fiscal drag, one of the least dramatic and most effective ways governments increase the tax burden without announcing a tax increase. It works like this. Prices rise, wages rise, partly to keep up with inflation, but tax brackets, deductions, or thresholds are frozen or adjusted too slowly. On paper, your income has gone up. In reality, you may not be richer at all. You are just earning more inflated money in a more expensive world. But because the tax system treats that higher nominal income as taxable growth, you may pay more. This is bracket creep. You get a raise to survive inflation, and the government takes a larger share because the numbers on the page got bigger. Your real living standard may be flat or falling, but the tax system can still collect more. Fiscal drag lets politicians raise the tax burden while claiming they never raised the tax rate. Then come fees, fines, tolls, licenses, permits, and charges, vehicle registration fees, court fees, parking fines, transit fares, road tolls, utility charges. Individually, each one may be defensible, but together, these charges raise the cost of living without the political drama of a broad tax increase. A tax arrives as one big political fight. Politicians often sell tariffs as making foreign countries pay. The phrase sounds strong, patriotic, simple. But tariffs are taxes on imports. They are usually paid first by importers and often passed along to consumers through higher prices. Sometimes tariffs serve strategic goals. A country may use them to protect an industry, strengthen bargaining power, reduce dependence on a rival, or defend national security. But the cost is real. Domestic consumers may pay more. A tariff is a tax with a flag wrapped around it. Tariffs sound like punishment directed outward, but their costs often move inward. If imported steel becomes more expensive, manufacturers may pay more. If imported goods cost more, shoppers may pay more. The idea that tariffs are simply paid by foreigners is usually too clean. Central banks add another layer. During crises, central banks can cut interest rates, buy government bonds, support liquidity, and stabilize financial markets. A modern economy without a lender of last resort is like a city with no fire department because fires encourage discipline. When governments borrow heavily and central banks keep rates low or purchase bonds, the state can finance itself more easily. If that support becomes excessive, or if too much money chases too few goods, inflation can become the pressure valve. That is why people can feel taxed even when politicians insist taxes have not risen. Sometimes the collection happens at the grocery store, the gas pump, the rent payment, the import price, the toll road, the licensing office, the utility bill, and the interest payment. This is especially powerful after inflation shocks. A household may receive a wage increase, but still fall behind because prices rose faster. Then, frozen tax thresholds increase the effective burden. Higher interest rates raise mortgage or debt costs. Public fees rise because governments face budget pressure. Tariffs or trade restrictions push up import costs. Currency weakness makes foreign goods more expensive. Public debt increases future interest payments, which compete with spending on services. No single line item explains the squeeze, but the total effect is unmistakable. The state and the financial system are extracting more purchasing power from the same household. This is not an argument that taxes are bad. Taxes fund civilization. Roads, schools, courts, defense, healthcare, infrastructure, and clean water do not appear for free. A serious society needs revenue. The issue is transparency. Visible taxes can be debated. Hidden taxes are harder to see, harder to vote on, and easier to deny. A direct tax forces a political conversation. Should we raise this tax? Who pays? What will it fund? Is it fair? But inflation, fiscal drag, debt erosion, tariffs, fees, and monetary pressure often avoid that conversation. They let governments collect through complexity. The most powerful taxes are the ones people do not recognize as taxes until their standard of living has already fallen. So how do governments make you pay without raising taxes? They control money. They borrow against the future. They let inflation reduce purchasing power. They freeze thresholds and collect more through fiscal drag. They raise fees instead of rates. They impose tariffs and blame foreigners. They rely on central banks to stabilize debt markets. They shift costs into prices, interest, licenses, and currency weakness. And because each mechanism looks separate, the public often feels the burden without seeing the architecture. Financial freedom begins by recognizing that your real tax burden is not only what appears on a government form. It is also what happens to the value of your money, the cost of your debt, the price of imports, the fees attached to daily life, and the public debts that will shape future policy. If you only watch official tax rates, you miss the quieter forms of extraction. History shows that states have always needed resources. The honest ones tax openly. The desperate ones debase. The clever ones borrow. The modern ones do all of it, then explain that technically nothing was raised. If this gave you a new perspective, hit subscribe.